All right, good deal. I'm going to focus on this fall marketing time period and then the fall purchasing time period for stocker producers. So, got a lot of cow-calf producers out there that'll be looking to market spring-born calves this fall. We'll have a lot of stocker producers that'll be buying cattle this fall, carrying them through the winter, and talk about a few things that are impacting this market and how we think that's going to look going forward. So the overall summary, I say the profitability is waning for the cow-calf producer. That's more of an expectation than an actual occurrence at this time. We actually have very, very strong calf and feeder cattle prices. So even though profitability is much smaller than it was in 14 and 15, we're at very, very strong price levels for the traditional model that we're used to. And my expectation is that profitability will start to tighten the next couple of years. And I think it should tighten some this fall. I do think there's going to be some opportunities for margin operators to lock in prices and have favorable margins on cattle that are bought this fall, regardless if prices are low or high when those cattle are bought. Some risk management strategies can lock in a very positive margin at this time. And I make the statement that cattle feeders are betting on the come. And so let's just discuss that last one right now. Let's see here. That's not good. That screen's not changing. It changed once, but it won't change again. I'll tell you what, we'll do it from this one then. There we go. Now we're starting to cook with gas. There we go now. So slaughter steer prices have really tailed off. We had a very weak summer relative to probably what most cattle feeders wanted, because there have been several weeks of negative margins. But it's actually been amazing that we were able to stick around that 110 level essentially for the past 3 or 4 months here. All of June, July, and August, we've been in this 110 range, and I would have certainly, if you had asked me for my projections, which I'm sure several of you have heard my projections, I would have thought we would have went down into the 103, 104, 105 for a little bit longer than what we did. We actually did have some cattle that traded around 106 as the average back in July, and I would have thought we'd have lost a couple more dollars there and spent a little more time at that lower end. Not saying we still don't have the opportunity to go that low, but the way that cattle feeders have been towing the line and holding these cattle, they're gonna force the pack. They've been forcing the packer to pay for these cattle, and at 110 they're making some money. But at the same time, what we've seen is looking at some of the most recent data on closeouts on cattle. We made a significant shift from having cattle on feed for about 160 to 165 days all the way up to 180 days. And so what essentially has happened is we're holding those cattle a little longer, and that does become problematic, because one of the things that I think that this market needs to do to keep prices heading in the right direction or in the higher direction is to keep current with their marketings, which means they need to keep cattle moving through and not overfeeding them. But we've started to see a few cattle feeders holding on to cattle an extra 15 to 30 days, and those 15 to 30 days will add pounds to the animal, and which could eventually depress prices. I say my waning profitability for cow-calf is more of a projection than it is a reality at this point. Just look at how steady these 5 to 6 weight steer prices have been in Tennessee. We've been sitting around the 150 to 160 mark since April, and last week we traded at 151 on a 550 steer. So let's see, 150, that's 550, that's two. So we're talking about $800 or better, $825 or so for these animals. And $800 a head for a freshly weaned calf may not be profitable for every producer in our state, but it's profitable for a lot of our producers, and it definitely covers all cash costs. You know, and most of our producers, that's what they're concerned about, is covering their cash costs. And $800 a head is easily going to cover those cash costs that our producers are incurring. Feed costs are low. Hay costs aren't too bad. So my expectation for these prices is to move lower this fall. But if they follow last fall's pattern, that they're not going much anywhere. We'll have to see how that plays out. But my expectation would be for those prices to lose $7 to $10 in the next couple of months. Yearling cattle prices remain strong. This time of year, they're generally at their peak prices. We've had a good August, and July was pretty good. August has been pretty good, and I would say prices for these cattle will remain pretty strong into September before they start to find a little softness as well. Now, here's something I do want to focus on very, very quickly, but I think it is a key for a lot of our producers, and it has an overall impact from what's been happening across this country. Slaughter cows. At the same time, people sell their spring-born calves. They sell slaughter cows because they're weaning calves. They're putting them on a truck. They go ahead and put the slaughter cow on the truck because we're going to get rid of her. And generally, those prices peak in that May-June time period. Well, we've been trading again very steady in the mid-50s. Now we're moving towards the low 50s. If you look from mid-June till now, you can see a steady decline in slaughter cow prices. Well, my point of this is if you have slaughter cows that need to be moved, or for any of the extension agents that are on, and you have producers talking about needing to sell slaughter cows, my suggestion is get rid of them as quick as possible, or hold them through the winter if there's plenty of feedstuffs. And I say get rid of them as quick as possible. I don't mean wait until the calves are weaned in October or November to get rid of them. We're probably easily going to lose another $10 on these slaughter cows moving into October, November, December time period. The reason why the price never really escalated this summer like is traditional is because we had the drought situation that kind of took over lots of Texas, Oklahoma, Kansas, and then further west. And so a lot of those areas we're ended up pulling cows out of the herd and putting them into the slaughter arena. And so at a time when we typically don't have a lot of slaughter cows, which means we don't have that very lean beef that comes from those slaughter cows, this year that drought forced a lot of those cows into the auction market and into a slaughterhouse because there was no forage available. So that depressed prices this summer. All those cows won't be there to go to the market this fall, but there are still going to be plenty of slaughter cows going to market this fall. And if you hadn't already marketed them, right now is a great time to get rid of them while they still have a pretty decent salvage value. Otherwise, if you wait 2 months, you're probably going to lose $100 a head compared to today. And also at the same time, you'll be marketing them at probably their lightest weights of the year, just because they'll have a calf coming off of them at the same time when forage quality is poor. We continue to have really, really strong heifer slaughter. It's up 8% so far this year. That just telling us again that we're not retaining as many heifers in for breeding. I don't know if there's anything much to say there other than that's pretty much expected when cow-calf profitability starts to get smaller, we're going to send more heifers to market. We have a pretty good size cattle herd as it is. Dress weights are up, so we're harvesting more. Dress weights are up compared to a year ago, which means even more beef on the market. Steer slaughter is actually down 1% compared to a year ago, and most of that 1% has come in the past month. And that's goes back to what I was saying with holding cattle longer in the feed yard. When you stretch it out from 160 days to 180 or so days, that's nearly a month's time period. So you're looking at 3 to 4 weeks in which cattle have been left on feed. Well, that makes sense why steer slaughter would be down. The heifer slaughter is up just because there's that many more heifers in the marketplace to be harvested. They're being left on feed longer as well, but there's a lot more of those girls that are on in the feedlots. Steers, on the other hand, we've had a short-term decline in steer slaughter, and that's because cattle have been on feed a little longer. That number will pick back up once those animals start moving through again. Beef cow slaughter up 11%, still a strong number. A lot of that has to do with those drought months. You can see the entire year we've had really, really strong beef cow slaughter, and we're going to continue to have strong beef cow slaughter. And if you look over in the November time period, late October, early November, that's when the majority of those cows end up going to harvest. And so if we've been above year-ago levels so far this year, I assume we'll be above year-ago levels when we get to this fall, which is just going to further depress those prices that I was mentioning. So we've got, because of all of the increased slaughter, heavier weights, steer carcass weights are up as well. We've got, so far, beef production's been up a little over 3%. Pork production's up a little over 3%, and broiler production's up 0.3%. So broiler production, not really much change there. So we've got several different issues happening, and Aaron alluded to a few of those issues. We've got some China trade disruptions. Most of that trade disruption comes in the pork and soybean arena. So from the crop side, China is a key market for soybean. From the livestock side, it's a key market for pork. China is the largest producer of pork in the world. They're also the largest importer of pork in the world. Who are the other primary producers of pork? Well, the European Union would be a primary exporter of pork to China. We're a primary exporter of pork to China. But all of a sudden, same as the soybeans, when you have the trade issues that we have and increase of tariff rates of 25%, it slows down the movement of those products directly from the United States to China. Now, does that mean that they don't go through somewhere else and then go to China? Sure, they can. But that's going to lower the value. And I think Aaron's graphic on that difference between Brazilian soybean prices and the Chicago Board of Trade soybean prices going from 50-something to $1.50-something is a good example of how the trade disruption with China and that tariff rate has impacted our market relative to other countries' markets. Again, we need to keep some focus on this Japan tariff rate. We need to be working out some type of agreement with them to lower our tariff rate into that country. The key trade competition remains to be Australia in that part of the world. We're going to have to find a way to be competitive on a price basis. We're more than competitive on a quality basis, but we also have to, at some point, if things get cheap enough, it's all right to buy a little bit lower quality. Aaron made a comment that he feels pretty confident about NAFTA renegotiations. There has been some positive rhetoric towards NAFTA as of late, but it's still been very slow to progress. maybe part of Aaron's positiveness is he's a Canadian, and he just knows we're going to get a deal worked out. But it's just been a slow process, and when you have your two closest trading partners and two closest allies, you need to get some of these things figured out, because there might become some bigger issues that need to be handled together. And so I do feel confident that we'll get a new NAFTA agreement put together in some form or fashion. Will it still be known as NAFTA? I don't know, but it is what it is. Another thing, I know this isn't in the cattle industry, but the African swine fever has been a hot topic in the media the past few weeks. China has had a few cases of it. I say a few. I think it's been 3 confirmed cases of African swine fever. Russia continues. Russia is also a large pork producer, and they've had several cases confirmed. Wild boars carry this, but it gets into the domestic pork production, and these animals, it's kind of similar to that porcine epidemic diarrhea virus. It spreads very easily. So anytime you have animal movement, for instance, in China, some of these animals may be hauled, 1,500 miles. Well, in a 1,500-mile haul, what'll happen is they don't leave those hogs in those trailers the entire time, and what they end up having to do is wash those trailers out a couple of times on their way from their point of origin to their destination. And so when they're washing those trailers out, a lot of times they get washed out right on the road, which is where more hogs are going to be hauled. Well, then, so if any of these animals have this disease, well, then all of a sudden contamination becomes even more and more favorable. There's also some research going on related to feeds carrying certain diseases, and there's some diseases that are readily carried through feed, and that survive that transportation fairly easily, and others that don't. It just happens to be some of the more severe diseases can survive in feed. So they can easily survive in feed and feces, and contamination becomes a problem. Well, what this has done, that's a long way of telling you, even though the Chinese trade tariff situation depressed pork prices or hog prices $15 to $20, about half of that was regained as this African swine fever news continued to break. So that is, that's a good thing. The problem is if this African swine fever were really to put a hampering on the herd and kill out a bunch of animals, it could end up negatively impacting the soybean market. We're looking at feed usage, and so those are things that we have to remember. That's how all these things are tied together, and not that it's a great concern right now, but it is important. We continue to have really strong imports and exports in the beef arena. Imports are very much in line with where they were a year ago. A lot of, again, most of our imports are that lean grinding beef. A lot of these imports are coming from Australia and New Zealand, who some of their key beef cattle regions have suffered from severe drought again this year, and so they had to move a lot of those cows out. When the dairy industry is struggling, New Zealand moves a lot of dairy cows out, and we pick up a lot of that beef. Imports from Mexico and Canada have remained fairly strong as well, and probably will continue to do so, especially with the strong prices that we have in the market. Exports have been extremely strong. same trading partners that we normally have: Japan, South Korea, Hong Kong, Taiwan, of course, Canada and Mexico remain some of those. I guess the key on this is currently through the first 6 months of the year, we are a net exporter on a quantity and value basis. We've been a net exporter on a value basis. That's a perennial occurrence. It's not that often that we're a net exporter on a quantity basis for beef. By the end of the year, I don't expect us to be a net exporter from a quantity standpoint, but a lot of that has to do with trade issues, and we'll see how those come out to play. Packers have been very satisfied this year. A lot of strong margins, a lot of triple-digit margins on a per head basis. They're starting to get a little bit of the strength in the market. I expected these prices similar to live cattle. I thought live cattle would trade down to 103, 105 range. We never got there. I thought the choice box beef would be trading at the $200 mark. We never got there. I think as low as we got was maybe 204 or so. And that doesn't mean we can't go back down. You can see by this chart that we traded around 210 last week. We traded as high as 231 or 232 back in the spring. There's a good possibility following the purchases for Labor Day, which should have been completed, that we may see this slow down and this market go back down, and it may break below the $200 mark. I guess we'll just have to wait and see. But there can be some softness following Labor Day as the fall market moves forward. Some of the strength probably has to do with that reduced slaughter rate to some degree, even though beef production is still up, because the expectation would have been if cattle continued to be moved through the slaughterhouse as fast as what we had been moving them through, those prices would have been depressed just a little more. We may just be putting off the inevitable for a little longer. We'll see how that goes. The drought monitor, I think Daryl Peel had a little article from Oklahoma State, and he made a really good point. The drought monitor is a good example of long-term trends of what the drought situation looks like long-term, because the Southern Plains have actually received some good rainfall the past week or so, and so that rainfall is not accounted for in this particular graph, which will be updated again tomorrow, and so we may see how that changes tomorrow. But a lot of the rainfall that we got scattered showers from this week and last week, they had good rainfall from those systems, and so we still have a lot of portions of the country that are suffering from some drought situations. A lot of cattle country. I tell you, the northern part of Missouri is maybe the largest cow-calf portion that's really being impacted. There's a lot of cattle up there in the northern part of that state, and just in that state in general. And so them in Kansas are being hit pretty hard. I realize out west, you can see there's a lot more drought out west, but I think they're more used to it than northeast Kansas and Missouri and southern parts of Iowa. Hay prices are pretty strong. We've had a pretty good hay year from the standpoint of some favorable weather at times to get it up. I guess our situation is we've had very spotty showers. Some places have been really wet. Some places have been really dry. And you can tell that through pastures. You can tell that through crops. There's probably been more wet spots than there have been dry spots. But hay production has been there in the middle. So we'll see how that plays out. This is we're going to get new numbers on for August on Friday. This is cattle on feed. We'll be sitting around 11 million cattle on feed based off of expectations. So we're going to be about 4.5% higher than a year ago. Again, I'm going to go back to talking about the number of cattle on feed that have been on feed longer than what we would expect. Over half the cattle will have been on feed 90 or more days. So if you expected that cattle were moving in and out of the feedlot in 150 to 160 days, well, now all of a sudden they're 180 days. That's why we have more than half the cattle on feed more than 90 days, and that number may grow even more as we move into the fall months, just because of these delayed marketings. I sure hope it doesn't. I hope cattle feeders continue to move cattle out, primarily because that helps our feeder cattle market. But these feedlots are, again, like I said, betting on the come. And what I'm saying there is, we have really, really strong feeder cattle prices relative to live cattle prices. And betting on the come means they're expecting prices for these live cattle to be higher later on. And so that's why they're willing to pay what they're paying for feeder cattle. And well, it's really hard to, that's a huge gamble. But when cattle feeders have a few dollars in their pocket, which they still have a few dollars in their pocket from the large margins that they made last year and that they made early in this year, the first couple or 3 months this year. And so they're still spending those dollars, hoping that these prices are going to go up. They don't have to have large margins. They just have to have small margins to go across a lot of animals. And a lot of these feedlots do have lots of animals. Cattle feeding, it's pretty cheap to feed cattle. This is total cost that experienced in Kansas feedlots, still pretty cheap. Look at where we've been. This is the October feeder cattle graph from pretty much the end of March through current as of yesterday. The market still hadn't even opened today for cattle, so we've been as low as 138, 137 type area, and sitting at the 150 price point. In pretty good shape. I would encourage people for people that are wanting to market cattle this fall, if you want to keep holding on to them, if there's a way to market your cattle now and continue to grow them until October or November, I would suggest getting that price. If you can forward contract them, whatever it takes, I would suggest doing it right now, because I don't think these prices are going to hold this strong through that time period. Even if it loses $2 or $3 on an 8 weight is $16 to $24 a head, and sometimes that's the profit in those animals. This is March. March still very high prices moving into 2019 based off of the futures market. That this is why I have some bullish tendencies on the ability of being able to move cattle. Fed cattle price forecast is pretty strong throughout the next 12 months, which again should support those feeder cattle prices, but they shouldn't be as high as where they're sitting right now. Here's looking at the 7 to 8 weight steers and heifers that are load lots, again with 5 to 6 weight weekly run auction market cattle. So I've got prices lower for those cattle on those 5 and 6 weights. I know we're out of time. I'm going to just quickly show expected value of gain for stocker producers October through March. Now, this expected value of gain is if you lock in that price, $1.28 moving from October through March, with an expected sale price at $139 for 825 pounders. But you have to lock in that price to witness that value of gain. So I've got, here I've got $6 or so that we're dropping from now until this fall on those 5 weights. And I think prices could be lower than that. but you got to lock in a price. Again, looking at January to June of next year, expected value gain of $1.21. So you could go ahead and hedge the purchase and the sale of these animals, and be looking at a value of gain of $1.21, which is pretty good. So with that, y'all can read the summary just as well as I can, but pretty favorable for adding weight in the stocker level. For those that are on the phone that probably can't read it because you can't see what we're showing, cow-calf producer revenue is going to be tightening, and we're going to have prices moving lower for a few years. On top of that, these heifers that you retain for breeding this year and next year may be some of your most profitable heifers that you've kept in a long time. That's just an expectation of what we're looking at.